So, trying to see what we're supposed to do. Oh, wrong class.
So, Bruce, the image that you were talking about, was that on the instruction page?
It was on the Excel document.
Oh, because I think I see which page is it on?
Like the financial model page, I think.
No, page 2.
Yeah.
Page 2.
Yeah,
So you don't see the image?
The graphs.
Okay, yeah, I don't see the graphs either. I just see an image.
Yeah, so I think there's just something up with that.
Yeah.
All right. Okay.
So yeah, it's a lot of questions that they want us to go over.
Yeah, I guess we can start with number 3 and just kind of go through it quickly.
Yeah. So far in this course, we have seen a few common threads and takeaways. We have seen founders matter, experience, passion, and vision shape the business and can make the difference between success and failure. And then business plan at the founding stage of the company is a collection of hypotheses. In other words, guesses. Startups create value by systematically testing hypotheses and making changes to the plan when the test result indicate the need to change. Early tests tell us a lot about the valuability of a business and where more information is needed. Previous cases analyzed business models the founder had already chosen, and so he had chosen the traditional strategy, razor and razor blades, and data analytics. And I guess we're going to then vote for which one we believe each individual to choose from.
Okay.
So one
go
of you
ahead.
can start.
I'd go with the data analytics one. Because even though it's the most risky, it also has the largest potential payoff out of all of them.
Yeah. What about you, Benjamin?
Well, I mean, like the data strategy. So if you look at the graphs, and if you're looking on the last date, so I can't see exactly where it says, just the graph cuts off. What is that, 2000? I can't see where it's basing the information off what that far end is. 10 years from now, it's growing so exponentially that that's where your market is.
Well, theoretically, but I mean, I just don't think it should be accepted purely like based off of what it's doing, because it's like it's a big assumption that everything's going to move to like data, because like the foundational, kind of like how the thing was comparing it, like
yeah,
this doesn't seem like it's a true straight line, but
yeah, no, there's definitely like so the data one has a lot more time in the negative. It takes almost 10 years for them to come back to positive. And so does the razor blade. And if they're going to get a market share, they're going to have to do something different. So it's either doing the razor blade or the data, in my opinion. What do you think, Patrick?
So I went over it, and in traditional sales, you have too many bigger competitors to deal with. And what they are mentioning that is that they can lower the price, which I've mentioned in different other cases, is that they can lower the price and you will be taken out of business because you cannot compete sometimes with prices. And then these companies are raising the prices when you're gone.
Exactly.
And then first of all, I was thinking of data analytics as well. But I was thinking is that I think they should start with the razor and razor blade investment, and then go when they see that they are successfully bringing in money and things are going positively, go towards data analytics. Because it doesn't I mean, it doesn't mean that you cannot change down the road in the future. They have already borrowed a lot of money, and so it's going to take them a while to pay that off. If they go to data analytics, they're going to have to borrow a lot more money than they have already borrowed. And so that put them, this is first risky to get into that business. And because of this more is a very high risk, but also a lot of money going in towards the to start the data analytics. I don't think they might be able to survive before they see a success in it.
Yeah.
So that is my thinking about it. But like I said, I start with the razor and razor blade, and then when they see that investments start going, then they're making money. They can maybe start investing in data analytics, because then also they have started with the networking, which they need to also build that relationships to get that off the ground.
Yeah.
So that is my thinking about it.
Yeah, and I think like you said, the traditional strategy, you think of like gas companies do the exact same thing. They just drive out any producer until they're the only ones. So they just can't make people function. And it talked about you could do a hybrid. I mean, there's a hybrid between razor blade and data. Use the razor blade and then also sign into the contract also that you're taking data.
Because also, if I broke it down, the positive and negatives on each. On traditional, they are talking about the demand of only approximately 2,000 devices. That is not a whole lot. Yes, you have a lot of more margin, but what after then? You're only going to, if you were able to sell to all those 2,000, you're only going to making $80 million, but you have competitors that can take your market, and you don't have a chance to get into that market because they are like they mentioned, they can say to these companies that are already purchasing, to say, okay, if you're only buying with us, you get the special deal or something like that, so yeah, so I think that is out of the picture. So
yeah.
Okay, so saying going down for each of the options, the number of potential customers. So you're saying 2,000. Yeah, the traditional strategy is the most limited of all of them.
Yeah, it's there.
Especially when you have big, rich competitors,
Yeah. On the razor and razor blade, they had the potential to, around 47,000 research labs. Not all of them, of course, going to purchase a machine, even though prices are going down, because not all the labs are doing research. But it will open up an opportunity for a lot of them that want to do study to all of a sudden be able to purchase. They don't need a lot of room, and it doesn't cost them a lot of money. So
yeah.
Yeah, traditional competitors are all the other companies, right?
Excuse me, what did you say?
Oh, if we're going down like these questions for each of the strategies, so the number of potential customers is 2,000. Which customers would be expected to pay for their product? just like the science labs and stuff or whatever. Who are the competitors? It's like all the existing people basically that are doing high end stuff.
Yeah.
Yeah.
The founder's goals, the investor goals.
So the founder's goal, like, I mean, on all of them, he wants to change the market. And then he kind of talks about how the traditional one does get him into the market and change it. But the biggest change happens when it's either the razor blade or the data, but especially the data.
Yeah.
Because it's producing a new market that doesn't exist. So, but the investor's end goal is to make money as quick as possible and as fast as possible. So the traditional model, even though it's risky, is where they're going to make the most money the soonest.
Yeah.
So the return on investment is a lot higher.
You think it's going to be faster?
Well, based
I don't know.
on the information that we're given, the break-even point is year is like 1, 2, 3, 4, 5 years out, and then they're instantly making money. And the rest of them are like 10 years out before they even make $1.
Yeah.
So the investor wants to do traditional, but the founder wants to do the other two metals model.
Well, it just depends on your investor too and their tolerance for risk. Because, I mean, I could definitely see a lot of long-term investors being really interested in.
You just need deep pocket investors, like he said.
Yeah.
Yeah.
So
gold diggers.
gold diggers. So using the plotting to allow the students to vote. So if we increase EBIAT divided by cells and hold everything else equal, time to pay back. So I don't know how we can do this if these things aren't working.
Well, that's what the other part of the Excel sheet was about.
Oh, that first one.
Yeah.
So if we keep everything equal and increase that, say if we increase it to 10%. Why my graph's not updating? All right. So as we increase EBD divided by cells, the return on investment sooner. The amount of time negative is less.
Yeah, I mean, if you're changing the sales growth, that will take a longer time. And if you're changing the EBAT sales, if you're putting a higher number there, that will go. It made more. It go faster for for the free cash flow.
Yeah.
Why is it earning before interest and taxes divided by cells? Like, what does that tell us?
Earnings before interest and tax. So how much of our sales?
Or how much of our earnings is?
No, divided by sales. So sales. How much of our earnings is based off sales? Is that what it would be?
I don't know.
From an outside investor? I'm going to Google it. Oh, because it includes non-operating income. It would tell us the proportion of our sales that are just from operating income. So if we increase our sales from operating or our income from operating income, then our annual cash flow would increase. Yeah, that makes sense. All right. What says everyone just wants help from everyone else compare answers? See, is your guys is that image showing up on the below on the curve below? Which statement represents the highest burn rate? Is that showing up on Island for you guys?
What are you talking about? Benjamin?
So on these questions, there's supposed to be a picture. Is that showing up on your computer?
On my Excel sheet?
No, on the list of questions that we're going through for the discussion.
That image is not showing. I already emailed the teacher about it.
Oh, okay.
Yeah, it's not showing for anybody. I checked on the PC. I checked on the Mac. I checked through Mozilla. I checked on Google. It's not showing up. Yeah, so I contacted BYU. They said, "Oh, you should contact the instructor about it." So,
all right.
Yeah, and I don't think it will be fixed today. So.
The something assets.
Come again.
You're cutting out a little bit when you talked.
Oh, so the NOA divided by cells is the next one. But it's funny because we're all going to get the same answer because we all have the same cell sheet. Just like talking about like coming to an agreement on it.
Yeah.
Yeah, no, exactly.
Like the higher the, I don't know what NOA stands for to you.
It said
something of assets.
Net operating assets.
Oh, okay, yeah, because I guess obviously the higher the net operating assets you need, the longer it'll take to pay back.
No, higher the net operating.
No, it definitely makes it go down.
Oh yeah, you're definitely right. Yeah. So if you have like so much capital building your operating, and then you divide that by sales, yeah, it would take longer to sell it back. Yeah, you're right. So that will, what does it do to your cash flow? So I put that back at 5.
Which question do I
The higher it is, the smaller your cash flow is going to be because you have to put it into assets. And
Right.
That's all is out in the model.
Exactly. That's what I just figured out when I changed it. Okay. So I guess we can skip that question with the blank and then just talk about this last question. You guys good to move on?
Yeah, which one are you talking about, the last question?
So once everyone has responded to the questions without help from anyone else, compare answers, discuss with the group, settles on the single response. So discuss as a group what strategies have we seen that flattened or lengthened the cash flow curve, especially try to draw the cash flow curves from Dr. John's products, Rent Runway, Dropbox, as well described in this case. Just make a rough gesture as the shapes of which the cash flows curves.
Okay, yeah, okay.
So Dr. John's product, what was that again? Do you guys remember?
That was the tooth brush.
Oh,
Yeah.
okay. So he probably had a low net operating assets cost.
I think he has the best. I think he has the best cash flow curve.
More than Dropbox?
Yeah.
Why?
No, I don't remember now. I was just looking at the numbers. I think his number looked. I don't have the case in front of me, but I think his number was looking pretty good because he had low. He was having low cost and low investment because he was going to sell it anyway. So
Yeah.
Yeah.
So, I mean, what would make his numbers low in the sense of they can be low just because his quantity's low, whereas Dropbox would be a little bit higher, but the thing is they have more potential for growth.
They have more potential to growth, but they have also more investment into it compared to John. So based on the information that we have at this moment, I think John has the best outcome at this moment. But in the long run, yeah, Dropbox probably had the most success.
Okay. So then the next question is asking, like, say John would have built an independent company rather than what he did. How would that have changed his curve? And I think it probably would have made it so his cash flow was less because now he has a huge asset that he has to be able to pay off when his sales are going to be proportionately not higher or high enough.
Wait, so describe to each other what would happen to Dr. John's if they decide to build an independent company rather than get acquired.
Well, he had to build an inventory, which costs a lot of money. Even though you have a big amount of sales, you still have to build the inventory, which costs a lot of money.
His net operating assets would be high.
Yeah, exactly.
And therefore his sales, his net operating assets divided by sales would cause the cash flow to be lower.
Yeah.
Yeah.
I don't see why we're doing this, but
what, analyzing business models and like
no, I guess like going back, it's like, okay, this is just, I feel like it's over repetitive.
Yeah. Well, if they built an independent company rather than acquire, what activities would you have to do differently? What impact the cash flow for some other activities? Shallow or deepen? Flatten or steepen, shallow or deepen, increase or decrease time for that.
Well, we have jumped to C now, or?
Yeah, I'm good.
Well, I don't know. Okay.
Go ahead if you have.
Do you have more to talk about B, Bruce?
Well, I was just thinking, like, did we talk about like the actual shape of that curve? Because it seems like, because like the model is based off of what? Like it's, because like the cash flow thing. So it's like with his, like the burn rate obviously was like all the research time, but then they like an inflection point. But I don't know if they ever got to cash flow positive in the case study that we were talking about. Because I mean, even though they were bringing in money, I don't know if they ever like were like rebounding out of that, or if they weren't, you know.
If they covered all their capital investment.
They what?
If they paid off all their capital investment, which would pull them positive.
Yeah, so I don't know if they did or not, but like it seems like their burn rate, they would have had a, like, if you do your own thing as opposed to just going into a company where you can plug and play like the systems, it just seems like the shape of their thing would be like really deep and then go way up, you know?
Yeah, it definitely has potential to go back up, yeah.
So I mean, that's what the shape would be. And then like to flatten the burn rate, like I guess to flatten it, it's either you have to make up a bunch of cells or like you have to have a bunch of cells, or you have to cut cost.
Yeah.
Well, for Dr. Johns, if you put in the sales growth, and they start increasing, and the NOA increases, then the curve will flatten out, which I think will be happening with Dr. Johns if he would have proceeded and build a business out of it.
Yeah.
Yeah. I agree.
I think definitely it flattened out, or it would have flattened out if he would have proceeded and build a business. So.
Yeah, I think if he got like getting acquired would make it flatter, I think, and then doing his own business would steepen it and make it more deep.
So,
I mean, Dropbox, I think, would be different, though. I mean, the investment is mostly probably in the beginning, right?
Yeah.
To create their websites and all that, but then it's already in use, and they maybe do some upgrading along the way, but that is not it's not going to cost as much. So the curve probably will go up more, it will not flatten out as it will happen for Dr. John's.
Yeah. So discuss the same for Rent the Runway. If the founders of Rent the Runway had been able to convince dress designers to retain ownership of the dresses, what impact would that have made on RTR's cash flow curve? Flatten or steepen, shallow or deepen, increase or decrease time to pay back?
So it would have flattened it because their burn rate was so low because their investors' capital would be less. So if the actual designer still owned the dresses, then they wouldn't have to pay for the dresses, which would be which would cause the graph to have a lower burn rate. So if they can eliminate that, it would lift the burn rate up, and they can start making a positive money for their investors.
So what you're saying is the curve will be go up in quicker or longer?
Well, the burn rate would be up higher, but I don't think they would be able to excel as high because now they have a cost.
Yeah.
Yeah. Well, I think it would have been dependent on because I mean, what if the people would still own the dresses, but they charge like a heavier, like just fee for renting it from them or something?
Yeah, exactly. So that would flatten it.
It could have gone either way.
Yeah.
Okay. So then question D, what happens if Drew Hudson make in Dropbox that favorably impacted his cash flow curve? Or what decision, sorry. Wasn't it him not having servers? Because it decreased how much of the investment was and how much of it would lower the net operating assets. So that way the cells were producing more than having to pay off the net operating assets. What are you guys' thoughts?
You not have servers? You have to have servers if you're going to store stuff like data.
I know, but he did it a different way, didn't he?
I can't remember, but
he rented from Google.
He used the Amazon.
Oh, Amazon, that's right.
Amazon web hosting or web services.
So he didn't own servers himself.
Oh, okay.
So he just rented them. So therefore, it would take money out of his cells, but he wouldn't have net operating assets that he would have to account for.
Is that operating assets just like the assets required to run the business or something?
Yeah, so it's like factories, machinery, everything like that.
But isn't that like property, plant, and equipment or equipment?
Yeah, but those are all assets.
So why is it net?
Because it's the total assets that help operate.
Well, net is generally something minus something equals something, right?
Let me double check what net operating assets are. Net operating assets are the business operating assets minus the operating liabilities. Not operating assets is calculated by reforming the balance sheet so that the operating activities are separated from the financial activities. Right. So they take anything that produces their operating income and take out any investments and notes and bonds that they own, so that their income isn't based off that. It's based off solely what their business is producing, or their main goal of the business is producing. So if Dropbox doesn't own any servers, then their net operating assets would be lower, so that ratio would be lower, which making their graph more steeper.
Right.
Yeah, if you lower the net operating asset curve or an amount, then yeah, the curve goes up quicker, and you can pay off quicker.
Yeah.
Yeah.
So, are you good with that, Bruce, or do you want to?
Yeah, that's fine.
Talk about it more. Okay, so then E. Now let's look at choices. Jen Aspie, I don't even know how to say it, has from cash flow standpoint for each of the business model options under the consideration, compare the following. Net present value. If some of the options have similar net present values, which is riskier? Is it advisable to take additional risk for a similar net present value? Oh, okay. So this is like asking, if we go to slide 3, if we look at the net present values at the end, so like traditional and Razor in 10 years produce pretty much the same net present value. Is it wiser to take to be more risky with the Razor blade than the traditional value to earn just a tiny bit more net present value? I guess I said that backwards, sorry.
Well, yeah, like traditional obviously has the better net present value than the Razor, but the data analytics strategy is much, much, much higher.
Exactly. So it's just saying which one they have similar net present value. So is it advisable to take additional risk for similar net present value? That's why I was talking about traditional and Razor. And I think from an investor's point of view, no. But if you're trying to change the market and you can't truly graph what's possible to happen, sometimes it is worth taking the risk so that you can get the return that you maybe can't calculate.
Yeah.
What are your thoughts, Patrick?
Yeah, I'm trying to play with this, and nothing is showing in the curve. So,
okay.
Nothing is showing on this model.
Well, I'm just wondering if it really is like the traditional, if that model is even correct for the traditional thing, because it's just assuming like that they can, like from whatever point, like it starts at like 2011 or whatever.
Yeah.
It's just straight up, But it's like you have those incumbents, and they're better funded than they are, and they've been in the market for a long time. So it's just like I just don't know if they've really factored in the risk like proportional to what it actually is, And if you could actually prove that the market is for data validation is working or is viable in the future, like if you can substantially see how that's going to be the future, it's like the true risk with the traditional model is that it's going to be antiquated, like because if they don't do something like the data strategy, then somebody else probably will. And like the traditional model doesn't work in that world, because it's like if you're giving away the equipment for basically for free, it's just like at cost, and then you're selling the data on top, like that's the model that's going to win in the long run, not the traditional.
Yeah.
Let's just compete.
Like you said, traditional will eventually disappear.
Well, and especially because like the traditional, his goal is that like the founder said he wanted to change the industry of research, and the traditional model doesn't help facilitate that, especially for small businesses and universities who want to buy equipment and teach people and be able to produce DNA results. It doesn't produce that. So it's like, I think the data strategy, even though it's a long-term riskier, it has the better results. So.
Yeah, and I guess to argue it from the other side too, or like the other way that we could look at it is like the traditional thing could disrupt the industry just because they have the same distribution channel as everybody else.
Yeah.
Like I guess they do really have a lower cost, like more effective like product, Yeah. So I mean, like that's one way that they could reshape the industry is they could just move the whole industry down with the cost, but like the risk with that is that you're going to be blown out of the water.
Yeah, because the big companies, obviously, it doesn't cost them that much to make those products. And because there was no market price, they set the market price.
Yeah, but the big companies also have the weakness of that they're kind of cumbersome.
Exactly.
What their or the other person, like these guys' Genepsi's product is, so
they can't change. All right.
Yeah, but you don't have that major 10-year cash flow negative thing going on though with the traditional model, which is kind of scary, you know.
Exactly.
Go from 0 to 80 million in debt and then hopefully get back out of it.
So then how will Synapse raise funds to support each option, and any option clearly more attractive to investors? Support your answers. So just right off the bat, the best for investors, traditional. Short term, I mean, for shallow pocket investors, is short term, quick reward. But for deep pocket investors, they want 10-year investments.
But one thing that we haven't kind of talked about is what if these big companies that are now in the traditional market, now they can easily, with deep pockets already, they can, even though if another company are starting up, if this company would start off with the data analytics, what if the bigger companies jumped into that market as well? Because just because one company are jumping into data analytics doesn't stop other companies to jump into that.
Well, I think there's a natural barrier with this type of stuff though, because there's like, it's not like you can just come out with a new like DNA scanning thing tomorrow, and so I think they're already caught. Like even if, I mean, Genapses probably has like a 2-year head start on anybody just because like it's hard to replicate what they did, you know, because everybody else, like, yeah, they're selling it for a ton more. So number one, like they have to cannibalize their own business. So it's like if you're selling a machine for $175,000, you know, a machine or whatever, like it's a big cut to your revenue to say, hey, okay, yeah, now we're gonna sell these for $3,000.
Exactly.
And so like so I mean I think that's one thing that would kind of keep them at bay, you know, with the data thing. But yeah, I think they have to start, but ultimately, like in the long run, yeah, they could catch up.
But like you said, Bruce, they're so cumbersome. They're so big that it's so hard for them to. They wouldn't be able to sell and just change their market. Like if you think even today, like say a big corporation, Microsoft decides to go change how they do something so they can match a different product. They just won't do that because there's just too much cost, and people who just bought the product will return all those products to get the cheap one. So
yeah,
there's too much risk to move the market.
So take a Netflix compared to Blockbuster. Mm-hmm. Blockbuster, I mean, they could have survived if they would have jumped on the wagon much earlier. What they did is that they just said they were comfortable. That's what happened with some big companies.
Exactly.
I think today's world is bigger companies are now changing a little bit because they know they need to be changeable. But before in the 90s and stuff like that, a lot of companies the big company became comfortable, like Blockbuster. And Netflix came in and they took market and they changed it, the whole thing. But if the picture might be looked a little different if Blockbuster had jumped on the wagon right from the beginning, and it was not the big thing for them to do that. But if they would have done it, Netflix maybe would not have been still around, and Blockbuster would still be around.
Yeah.
So that's what I'm saying is that say that one of these bigger companies have jumped on it because they have the connections with the labs and stuff like that, and what say that they would not jump on the wagon. I mean, that's what I'm saying. Yes, it's so.
No, that is a good point.
Yeah,
but I mean, I don't think there's a way for us to.
Yeah, you cannot predict the future. Absolutely not. Yeah. But those are the things.
It's a good thing to think about and be prepared for.
Yes. Yeah.
So we kind of talked about the last bullet point for each opinion, the company where the founders have to give up to reach that goal. Is there anything you guys want to add to that?
Well, obviously, like with the data option, they're going to give up a ton of their equity. Like unless they have some other way to fund it, like they're going to be diluted heavily. But I guess like maybe in 15 years that'll pay off for them.
Yeah.
which is kind of a crazy thing to think about, though. It's just like, yeah, you're gonna be
Negative for 50
negative
years.
for more than a decade. That takes a lot of patience.
Well, but we also don't know how long. This graph doesn't know how quickly the data will pay off. Because if they're starting to produce numbers, then the demand for the data will increase. So that's something that's not measurable easily or obviously. And that's what the market will have to show.
Hypothetically, though.
No, yeah, definitely. I agree with you. So as a group, what model do you think we should go with?
I personally think data analytics is too risky to start with, but still,
All right.
that is my thing. You know, even though you have investors that are taking risk and are looking for things, you know, you might have to find investors that for 15, 20 years, or at least maybe 20 years investments, and that it can be sometimes hard to find those investors. And how much is he willing to give up of his company to do so? Because I think that was one of the questions somewhere, I think I read.
Yeah.
Because, you know, is he willing to give up 40% of his company to succeed and get investor to do this? Because you will have investors that want to have shares in it. So what is your thoughts about it?
The greater the sacrifice. I don't know. I just think I think the data strategy is the best because it changes the market. They won't be easily, like Bruce said, the big companies can't buy you out quickly or drive you out quickly. And you'd be able to change the market like you wanted to.
Yeah.
So I think it's a little higher risk, but it has a bigger reward.
Yeah.
So I mean, I don't think we have to necessarily come up with our own, like a group thing, but
yeah, and I think I might go with the razor blade strategy. Just to like look.
it's changing. Yeah.
Yeah, well, just looking at that curve, it's just like you have to have a big stomach for that, and I don't know.
You do, and you need to. Like I said, you know, it doesn't mean that you are stuck with one model. This is just to start up. That's what they're saying. This is to start up the business. So say that maybe 2-3 years from they are starting, when they're seeing that the racer model is taking off, then they also can start investing in the data analytics, because then they have also built during that time they can build network. They can build that network which they need to start, because they need so many company or what do you call it, data information already to get it going, the data analytics. So I think it will take them a long time before this will even lift ground. So I believe in racer still.
So, but if you look at the graph, it's kind of deceiving. The I guess y-axis point or whatever, the point where it goes over the zero for razor blade is at 2022, and in the day that it goes over for data strategy is also 2022. So both of them are still 10 years in advance. The graph doesn't make it look like it, but if you hover over it, it'll show you the value of that point.
Yeah.
Yeah, but you also got to factor though that like it's going from 0 to negative 10 million as opposed to going from 0 to negative, 60, 70 million.
Yeah, so you just have a flatter curve. So do you want a flatter product or a more?
Yeah, but it's just like the risk is like tremendous,
Yeah.
like you're taking on 7 times as much debt to try to have a hopeful outcome. Like, and you're hoping the market is moving that way, you know?
Yeah, Racer doesn't have as a big dip.
Yeah, and I'd be interested to push these out further, what it would say in 20 years.
Because I mean, like, I don't know, maybe the smartest plan is just to do the traditional thing up to 10 million, then to start funding the data strategy, you know? Because like you shave off, if all you really need is to do is, well, I guess it doesn't really show like traditional until like the long term, like ever getting over 80 million. But if you really need like 70 million to do it, I don't know, maybe it's like it's better to do like the traditional for like, I don't know, 6 years till 2010. So you're cash flow positive in 2 years, and then you start doing the razor blade strategy, and then like whatever else or something. But then you spend less time.
But this curve doesn't though involve that, you know, the tradition only have 2,000. They say the demand of around 2,000 people. You have a higher margin.
Mm-hmm.
But what if you only get 100 people out of the 2,000?
Exactly.
You know,
Well, if you're selling, I don't know what their prices were, but if it was close to that 100,000 mark, then like makes it easy. You know, it's like you only need 2,000 customers.
Oh, but the prices were 40. The prices was 40,000 for the machine for that category.
Yeah.
Yes. So I mean, like you at least have a decent market, because probably those labs are the ones that actually need it. You know.
But
So I mean, like, yeah, like it could be limited, but like as just a means of like, I'm just saying, like if you started with the traditional model, you could become cash flow positive within 2 years, and then you could leverage that cash into like, okay, now that we have cash coming in, now we do the razor blade thing, or like, yeah, we decrease the cost dramatically. We go after it this way, and then we use that to kind of start playing with like the data structure stuff or the data strategy type of things.
But that's if they let you stay in the market.
Yeah, but you don't need to be in that. You don't need to be in that market forever. You know.
No. That's if the big companies let you even survive in the standard. Big companies are constantly looking for people who are trying to buy them, like to take part of their market, and they buy them out or they destroy them. So that's if the big companies don't notice you and you last 2 years.
Well, I mean, but it's also if the big companies could actually compete with their like value proposition, like cheaper, like better technology, like I mean, they do have some stuff going for them that would be hard to replicate. So I'm just saying, do that for 3 years, become cash flow positive, and then experiment with the other strategies, because even the razor blade one, like it drops you down pretty far before you're ever able to
get back up.
Yeah.
So, all right. Well, I actually got to get going, but
yeah.
I think we have enough information just to make your own assessment and to move on.
Yeah.
So, yeah.
I think we had a good discussion today, though. So.
Yeah.